Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 129, and in this episode we are reviewing the performance of the global markets during the 41st week of 2024, and that is from Monday the 7th to Friday the 11th of October. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where on Thursday, the Labor Department reported that the pace of price increases over the past 1 year was higher than forecast for the month of September. The Consumer Price Index, which is a broad measure of the cost of goods and services across the U.S. economy, this increased by a seasonally adjusted 0.2% for the month, which put the annual rate of inflation at 2.4%, with both readings coming in above the consensus forecast by 0.1 percentage points. The annual inflation rate was 0.1 percentage points lower than in the previous month of August, and excluding food and energy prices, the core consumer price index increased at an annual rate of 3.3%. This week's inflation data has provided more evidence that the Federal Reserve is nearing its objective of inflation at 2% shortly after cutting its benchmark interest rate just a few weeks ago. The consumer and producer price indexes for September both came in around expectations, showing that inflation is drifting down towards the central bank's 2% target rate. Analysts are projecting that the Fed's preferred measure of inflation, which is the Personal Consumption Price Index, which is due out this coming week, will come out at around 2%, which would be in line with the Fed's long-term target rate, and this comes about 2 years after inflation spiked to a 40-year high and unleashed an aggressive round of interest rate hikes by the Federal Reserve. On Wall Street this past week, a strong start to the third quarter earnings season provided a lift to the stock market. The S&P 500 and the Dow Jones Industrial Average powered to new highs on Friday and capped off a winning week as the banking sector ushered in a promising start to the third quarter earnings season. The broad market index, that is the S&P 500, gained by 0.6% to end the day at 5,815, whilst the Dow Jones rallied by about 410 points to finish the day at 42,863, as both averages hit fresh all-time highs and also managed to close at record highs. Meanwhile, the Nasdaq Composite added 0.3% to close the session at 18,342, which was less than 2% below its all-time record high. All the three major averages registered a fifth consecutive week of gains as the S&P 500 and the Nasdaq both jumped by 1.1%, whilst the Dow was up by 1.2%. And in the government bond market, the yield on the benchmark 10-year Treasury bond dipped below 4.1% on Friday as investors assessed the latest inflation data that came out cooler than expected. The yield on the 10-year bond slipped by less than 1 basis point to trade at 4.08% after having ended the previous week at 3.97%. Meanwhile, the yield on the policy-sensitive 2-year Treasury note was down about 5 basis points to 3.95%. The yield on the 10-year Treasury briefly topped 4.1% in the previous session, following a commentary from Atlanta Federal Reserve President that suggested he was open to the idea of possibly skipping a rate cut at one of the Fed's last two policy meetings this year. According to the CME FedWatch tool, the Fed funds futures trading suggests a nearly 90% chance that the Federal Reserve will cut interest rates by 25 basis points in November. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the commodity market, traders are worried that Israel will hit Iran's oil industry, potentially triggering a cycle of escalation that could cause a significant disruption of oil supply from the Middle East. And on the back of these concerns, the price of crude oil posted its second consecutive week of gains, as both the US benchmark and the global benchmark Brent gained more than 1% this week. Oil prices have gained more than 10% since Iran hit Israel with ballistic missiles last week. The price of the US benchmark, that is West Texas Intermediate crude, has gained more than 5% so far this year and was trading at $75.56 per barrel. Meanwhile, the global benchmark Brent crude has increased by more than 2% so far this year and was last seen trading at $79.04 per barrel. In the precious metals market, the price of gold rose on Friday after the U.S. inflation data cemented prospects of further rate cuts this year, which held back the dollar below recent highs, whilst safe haven demand, driven by geopolitical tensions in the Middle East, continued to boost the price of bullion. Gold is expected to reach $3,000 by 2025, mainly due to geopolitical tensions in the Middle East. For the second straight session, the price of spot gold rose by 1% to settle at $2,656 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the shilling remained relatively stable versus the US dollar, and according to data obtained from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at the same rate of 129.19. Meanwhile, the sterling pound was priced at 168.57 and the euro was valued at 141.29. And on the regional front, one Kenya shilling was changing hands for 28.45 Ugandan shillings and 21.09 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.42%. Over the past 6 months, the shilling has been relatively stable against the US dollar. However, that does not negate the fact that Kenya's underlying economic fundamentals remain extremely weak, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased for the fifth consecutive week and was up by $113 million to top $8.29 billion, which is equivalent to 4.3 months of import cover. This level of reserves is now in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing national debt that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was well supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined significantly by 62 basis points to 12.09%, down from 12.71% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market increased to 28.5 billion shillings, up from 17.4 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 33 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 10th of October, and the central bank received bids totaling 73 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 304%. The central bank ended up accepting a 31.1 billion shillings, and the results of the auction were as follows. The 91-day rate declined by about 69 basis points to average out at 14.99%, whilst the 182-day rate fell by about 40 basis points to close out at 16.09%, and the 364-day rate decreased by 39 basis points and eventually settled at 16.33%. In the primary bond market, the auction for the October bond issue was held on Wednesday, the 9th of October, and the central bank received bids totaling 50.9 billion shillings against an advertised amount of 30 billion shillings, representing a performance rate of about 169%. The central bank ended up accepting only 31.2 billion shillings, and the results of the auction were as follows. The first bond, initially issued in 2016 with 1.8 years left to maturity, the central bank accepted 28 billion shillings at a weighted average rate of 16.98% compared to the bond's coupon rate at 15.039%. The second bond, initially issued in 2022, with 7.6 years left to maturity, the central bank accepted 3.2 billion shillings at a weighted average rate of 16.95% compared to the bond's coupon rate at 13.49%. In the international bond market, during the week, the yields on Kenya's Eurobonds were on an upward trajectory and increased by an average of 16 basis points, with the yield on the 13-year 2021 Eurobond increasing the most by about 20 basis points from 9.7% recorded the previous week to 9.9%. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NSE 20 gaining the most by 1.9%, whilst the NSE 10 and the NSE 25 both rose by 1.8%, and the NASI ticked up by 1.7%. This takes the year-to-date performance to gains of 28.3% for the NSE 10, 25.7% for the NSE 25, 19.7% for the NASI, and the same 19.7% for the NSE 20. The market's performance was mainly driven by gains recorded by large-cap stocks such as Equity Group, KCB Group, and DTB Bank, which increased by 6.3%, 4.1%, and 2.5% respectively. These gains were, however, weighed down by losses recorded by other large-cap stocks such as East African Breweries, Cooperative Bank, and NCBA Bank, which declined by 2.4%, 0.7%, and 0.5% respectively. Up next is our topical issue for this week. And this week, we are looking at the outcome of the Central Bank's Monetary Policy Committee meeting. The Monetary Policy Committee met on Tuesday, the 8th of October, and reviewed the outcomes of its previous decisions and measures that were implemented to anchor inflationary expectations and maintain exchange rate stability. The committee met against a backdrop of an improved global outlook for economic growth, continued easing of inflation in advanced economies, and escalating geopolitical tensions in the Middle East. The committee noted that overall inflation declined further and is expected to remain below the midpoint of the central bank's target range in the near term, supported by lower food and fuel inflation as well as a stable exchange rate. Additionally, the committee noted that central banks in the major economies have continued to lower interest rates in response to easing inflationary pressures and with expectations for further reductions in the coming months. The committee also noted the sharp decline in credit to the private sector and the slowdown in growth in the second quarter of 2024, and concluded that there was scope for further easing of monetary policy in order to support economic activity and maintain a stable exchange rate. Therefore, the committee decided to lower the central bank rate by 1 percentage point from 13% to 12%. And in addition to the rate cut, the Central Bank of Kenya has also cut its economic growth forecast to 5.1%, down from 5.4%, and this is based on slower growth in the second quarter of 2024. The country registered a slower economic growth of 4.6% in the second quarter of 2024 compared to a growth of 5.6% for the same period last year. The central bank governor said that the growth prospects for 2024 had been revised downwards to 5.1% from the previous projections of 5.4% and reflected the slowdown recorded in the second quarter, as well as a decline in private sector credit to several key economic sectors. And on that note, we come to the end of this week's podcast. Thank you as always for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout, and it is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, a thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, we are all visitors to this time and place. We are just passing through. Our purpose here is to observe, to learn, to grow, and to love. And then we return home. Think about it. Thank you, and God bless.